Hey everybody, it's Saturday, August 3rd, 2019, and we're taking a look at the S&P 500 as we get ready to trade August week 2. So we had the Fed this week, which began a correction for us. You can see here I'm pointing to the candle that we made on Wednesday, followed by Thursday, followed by Friday. But on Friday, we did see a nice long buying tail on the candle for the day. Right at the end of the day, that buy program finally took us back above the 50-day simple moving average, and we did solidify a close back above the 50-day simple moving average. So now all we've got right now is 3 closes in a row below the 20-day simple moving average. The 10 and the 20-day are both curling over, and they will open in a bearish cross on Monday. So let's take a look at the history of the 20-day simple moving average and a break of it. You can see this was the last time we made a break and a correction below the 20-day simple moving average. And this was coming off of an all-time high at the beginning of May. And you can see that we did a poke down through it on one day, and then the next day we came in and gapped down below it. And then that was all she wrote. We never saw the upside above the 20-day simple moving average for many sessions. This went on from the beginning of, this went on for about almost a month, from the beginning of May all the way to the start of June. And then the last time we closed below the 20-day simple moving average was the bounce, the final, like the third day off of the bounce from the low. And then finally we regained it. And from here you can see this is where we made our all-time high launch too. And the area that we were in at the time was about 2830 or so, 2830, 2834 or so. So my guess is that there is a slight chance that the market in the end is going to want to come all the way back here and retest this area right here between these two candles. But let's take a look at some more scenarios right now. In terms of that, what would happen is that we would come in, we would break the 50-day, and we would break the 100-day, fill in both these gaps, and then maybe take a look below here and hold well above this breakout point for the quarter. For the last quarter, 28.17, and it would, like I said, about 28.30, 35 or something like that would test this area where we had regained the 20-day simple moving average before. But in order to get there, we would have to fulfill our double down target, which I put on here. This is just a simple doubling down of this candle that we printed on Wednesday for the FOMC and the Powell press conference thereafter. If we were to just double down that range, that would take us down here to about 2900 to 2898, testing the 100-day simple moving average. If we break down through the 100-day simple moving average, we do have a little unfilled gap here. Not little, this is actually like the biggest gap of all the gaps. It's about the same size as this big gap that we left here on the first bounce off of the low here, this gap up open on day 2 of the recovery. But this is a pretty big gap here that would fill in at about 28.89. So about a 10-point look below the 100-day simple moving average or so, and then perhaps reverse off of that. The most important point, though, is this. This is the halfway back point between our all-time high and this last swing low, the Q2 and June low here at 27.28. The halfway back point is 28.78. So this is really the key. If we come in, we break down through the 100-day, we fill this gap and break down a little lower, we need to see this 28.78 level hold. Otherwise, I do think indeed we're going to go ahead and at minimum test this area here where we made the breakout back above the 20-day simple moving average. And if that's not enough to hold us together, then we go down, test the 200-day simple moving average. And when you look left here, you can see that this was clearly an area that we tried to hold. Then we broke down below it for a couple of days and before finally recovering. So chances are we would break down through this. Maybe we hold this trend line. This trend line is just there to mark a trend. It's not something that you should hardcore trade off of. Trend lines never are. They're just there to show whether a trend is holding or breaking. And this trend line, this June low, so it's a good marker of the beginning of the year, the midpoint of the year, and now maybe the 3/4 point of the year here. Maybe we would come down and test that and hold. If the 200-day and this trend line breaks, then we have this final gap to fill that would take us all the way back to a solid test of the low that we made in June. And of course, the rule of the halfway back is that if you break the halfway back on a closing basis, you're looking to test the low of that range that establishes that halfway back. And in this case, that's 27, 28 level. If we come in on Monday and we, and we have a buy program going for us, that might be because we have this 10 and 20-day simple moving average pulling through to a bearish cross on Monday. And sometimes when that bearish cross comes at the end of a lengthy sell, then the market establishes a buy program to sort of fend that off and treat that as oversold rather than as the sell signal that it actually is. So if we do come in Monday, what we want to see hold is, first off, is the 50-day simple moving average. If we gap down open in any way below where we closed on, if we get down below where we closed on Friday, we want to at least try and see the 50-day simple moving average hold. If the 50-day simple moving average at about, it is rising here, so it's probably going to be about 29.29 or so on Monday. It was 29.27.50 on Friday. If we see that break, then we're going to fully back test Friday's low. But if we see it hold, we reverse and we look to make sure that Friday's close is taken back at 29.32. And when we look to the left, we can see that the area where Friday closed was an important area. It was the area around the last non-farm payrolls number before the one that we had on Friday. I'm sorry, this was a Fed meeting. The last Fed meeting and Fed statement before the one that we had this past week. So we are holding that area on a closing basis at 29.32. We want to see that hold. We reverse up and we try to take out the 29.45 handle. We take out the 29.45 handle. This is where our high was on Friday and our low was on Thursday. And we have a little gap to fill here to around 29.53 to 54. And when you look left again, you can see that this was a solid area of consolidation that we had on the way up. Okay, so we want to see 29.32 hold. We want to see 29.45 taken out. And ultimately, we've got to get above that 29.53 to 54 area and hold. And then we might just have a comeback, especially if we come in and we close back above this level on Monday. We might have established an interim low for now, and we can rally on back. And that rally is going to need to get back up here, and it's going to need to take back the 10 and the 20-day simple moving average. The 10-day is going to be falling very fast unless we get a really good strong rally and follow it through on Tuesday. Then that will flatten this line out and get it turning back up again. And then when that line turns back up again and crosses through the 20-day, that can be the juice that really gets the buyers to come in and the algos running back into rally mode. Okay, so I covered a lot of stuff there, but the most important levels in the near term are the 50-day simple moving average, 29.45, and then this 29.53 to 54 level. And once we get through there, then of course we have this 29.64 handle, which we established for a long time on the way up here, and I've been talking about that for quite a while. And then we work our way towards the 10 and the 20-day simple moving average. Once again, the roadmap gives you in great detail all the levels that you need to be looking at, especially as an options trader, which is the only pure way to trade the S&P 500 is with options. And this gives you a lot of detail in the levels so that you know if you're making good entries or exits. If you see that we're getting up to a level on the roadmap, that could be a level where we really see a big breakout, or it could be a sell program that comes in. So use the roadmap to your advantage as much as possible. The daily simple chart kind of gives you the bigger picture and really focuses on the gaps, the direction of the simple moving averages, and where they are at. Okay, so that's the best way to utilize those two charts that I try to post for you each day. Anyway, have a great rest of your weekend. I hope this gives you a good start to the day as we get into August week 2. Have a great rest of your weekend, and as always, good luck and good trading.